what real profit looks like in a Forex system. Understanding expectancy and avoiding unrealistic targets. When does a Forex system actually count as good? Over time, a system works if it makes money on average for every unit of risk you take. That average is called expectancy, and understanding it early keeps expectations realistic. What expectancy really means. Expectancy simply means the average profit or loss per trade based on real data from the system, not hope or emotion. It shows what the system delivers over time when the same rules stay in place. Expectancy is the win percentage times average win minus loss percentage times average loss. In simple terms, this formula compares how much the system makes when it wins to how much it gives back when it loses. The win percentage represents the percentage of winning trades, where loss percentage represents the percentage of losing trades. Average win shows the average gain on winning trades, and average loss shows the average loss on losing trades. When expectancy turns positive, the system makes money statistically. When expectancy turns negative, the system loses in the long run, even if a few winning streaks show up along the way. For example, imagine a system that wins 40% of the time but makes 3 R on winners while losing 1 R on losses. Expectancy is therefore 0.4 times 3R minus 0.6 times 1R, which is 1.2R minus 0.6R, and therefore it is 0.6R per trade. Even with more losing trades than winning ones, the system still produces a positive result. On average, each trade builds about 0.6R over time. Why expectancy works better in R, not dollars or percentages. Calculating expectancy in R keeps the strategy flexible and independent from account size or specific instruments. R represents the fixed risk per trade, such as 1% of the account. If expectancy equals 0.3R and the system produces around 20 quality trades per month, the long-term expectation comes out near 6R per month. At a basic level, monthly performance comes from expectancy multiplied by how many good trades actually show up. Therefore, monthly R is around expectancy times number of trades, which in this case is 0.3R times 20, which is 6R. Because 1R represents percentage of the account, 6R translates to roughly 6% per month on paper before real-world fluctuations. If 1R is 1% of the account, then 6 is 6% on paper. Expectancy alone does not guarantee income. Position sizing and trade frequency still matter. How to measure expectancy in a real trading system. To move away from fantasy, expectancy needs real data. That means tracking at least 30 to 50 trades with the same system and the same rules. Start with at least 30 to 50 trades using the same system without changing any rules along the way. Each trade needs 2 records, whether it won or lost, and the result measured in R. So win percentage is wins divided by total trades, and loss percentage is losses divided by total trades. Average win, on the other hand, is average R on winning trades. Average loss is average R on losing trades. Then plug those numbers into this formula. Expectancy is win percentage times average win minus loss percentage times average loss. That final number reflects the real performance of the system, not the version that feels comfortable. What counts as a good expectancy in Forex? Professional education sources agree on one thing. A slightly positive expectancy that stays consistent matters far more than chasing extreme numbers. Many solid retail systems operate with an expectancy between 0.1R and 0.5R per trade, with an expectancy around 0.25 to 0.35R, a reasonable number of monthly trades, and controlled risk, steady monthly growth becomes realistic. Higher targets usually require higher risk and bring higher instability. How to use expectancy for realistic goal setting. Instead of asking how much money a system can make per month, start with expectancy, trade frequency, and risk. First, calculate real expectancy. Second, estimate how many high-quality trades show up each month without forcing signals. And third, define standard risk per trade. Then calculate a theoretical monthly expectation. Monthly R is expectancy times number of trades. For example, expectancy is 0.3 R. Trades per month, 15. Monthly R is therefore 0.3 R times 15, which is 4.5 R. Because 1 R equals 1% of the account, that paper result comes out near 4.5% per month. If 1 R is 1%, then 4.5 R equals, of course, 4.5% per month on paper. After that, reduce expectations by 30 to 50% to account for execution errors, spread, slippage, and human mistakes. This approach replaces motivational targets with statistically defensible ones. Red flags that signal unrealistic targets. Targets like 10% every month almost always force excessive risk for new retail traders and often end in account damage. If reaching a monthly goal requires raising risk beyond 1 or 2% per trade, dramatically increasing trade frequency, or constantly modifying the system, then the goal does not align with real expectancy or risk limits. Even professional funds with strong infrastructure usually operate with annual targets around 10 to 30%, not monthly ones. Put simply, when expectancy and risk resemble a family car, expecting sports car acceleration leads to trouble. Many traders set 10 or 20% monthly goals long before seeing real expectancy on paper. Calculate expectancy from the last 50 trades. Does the number surprise or disappoint?